if you bought a condo in Canada at the top of the market, and many of you did, there's a real chance that you are either underwater now, looking at, getting underwater, or maybe just have been treading water for quite some time. And look, you're not alone. It's a shitty situation, but more than 1 in 3 people in Ontario alone who bought in the peak at 2022 and sold within the last year are selling at a loss. It's not great news. And in today's episode, that's what we're going to be unpacking. Should you sell at a loss? But we're going to dig a little deeper, provide some real examples, some real numbers. Then we're going to look through a bit of a decision framework, like, if you are forced to sell, what you should be doing, or other ways around it. And then, of course, we'll finish it off with what it all means for the market. Dan?
Yeah, I mean, this is a big topic. Like, we get this question all the time. At least I do in my DMs, more on the sales side, obviously, but people saying, like, should I rent it out? Should I add a unit? People are trying to make decisions on, like, can I add more cash flow and, get through this period of negative cash flow, or should I just dump it and cut my losses and move into a different thing? Like the stock market's looking pretty crazy right now. And so, we figured we've done this discussion a couple of times before, but I think, and we actually have a calculator for it on realist.ca for, should I sell versus rent? The reality is, like, the answer is going to differ for all people. And there's obviously the embedded disclaimer in that, where, like, we can't give blanket financial advice or tax advice, especially because this does weigh in on taxes. It's your capital gains, it's losses that you may put on your books, capital losses. Talk to your own people. By now, if you've been listening to the podcast for a long time, you should have a power team put together. You should have, an accountant or a lawyer or a real estate professional who can advise you through these things, or just give us a shout and we can connect you with those people and talk to you about your specific situation. But the reality is, every situation is different, and a lot of it is just going to depend on you. We're going to give you kind of the ways to think about it and the things, the numbers that you want to look at, et cetera. So I guess the question that I want to start with for you, Nick, is have you personally seen any deals like this come across your desk in the last month where somebody's trying to either do it from a refi or just some, whatever they call it, loss porn that you're seeing on Twitter or whatever?
Yeah. I mean, there's a lot of that going around, and we're going to get to some of those real numbers next. But I mean, short answer is yes. I've seen all too many of these, and look, they're never a fun conversation when they come to you or I, Dan, you on the real estate side, me on the commercial mortgage side of things. I mean, this is a tough conversation to have, and I don't enjoy having it. I enjoy helping people get out of tough situations, but it's hard to see the situations that people have put themselves in where appraisals are coming back light, you can't rent stuff out, rents are coming back light, you go to re-underwrite something that you bought in the last couple of years, and it actually, in a lot of cases, looks worse than it did when you bought it, but at this point, you are trying to, in some cases, get money back out of it through a refi or a takeout, and man, it's just tricky. So, same question to you. I'm sure the answer is yes, but maybe if you could share a story or anything like that.
Yeah, well, I think there was that one that was, like, I just put the article up on the screen for those watching on YouTube, but it was that condo that sold for like $290K, and it was like $145,000 loss. There's a lot, man. Like, there's a lot of I'm seeing it more on developers as well, where they're taking losses on land. Like, I think land values are down like 40% off peak. Like, if you think it's bad for single family homeowners on the development side, I mean, you have tons of forces, right? You have demand tapering off. You have, I got to find the land report from Bullpen here, but he has like a good chart on it that shows land prices basically dropping pretty significantly off peak.
Yeah.
And so, you are seeing quite a bit. And the bigger one that I'm seeing, because I do a lot of power of sale stuff and lender dispositions, and we report and have the power of sale tool, like, where people can look at power of sales and foreclosures on the realist site as well across Canada. So we spend a lot of time in this space. That's where I'm seeing interesting ones taking place, where, there's a lender in second who completely gets wiped out, or, a power of sale where, like, we had a power of sale where they literally were, it was a private, they were first, and they were at, like, I think it was like 75 loan to value, 70 maybe. And, the value had compressed so much that after principal, and outstanding interest arrears and commissions and all of those things, the lender actually ended up taking a little bit of a loss. So value had come down so significantly that it transacted at a place where even a 75% loan to value first mortgage didn't protect the vendor there. So definitely seeing it, man, 100%. And I think I don't know your thoughts, but I feel like, the question is like, are we past it? Or is there still worse to come because people are still going to starting to go delinquent more on mortgages, and you're starting to see more of those power of sales, or people running out of, I told myself I would only be cash flow negative for 2 years, and I thought it would be better by now. I thought rents would be back up, or, prices would be back up. And now they're realizing that exit that they had originally forecasted isn't there. Are we seeing more forced sellers? And I think you're still kind of early, like I would say halfway through it on the forced sales side of things.
Yeah, I agree. And I don't want to belabor that because I'll come up a couple times throughout the episode here. But I mean, I don't think we're at the end. I don't think we're at peak. We might be at bottom. That doesn't mean we're at peak pain for a lot of people, right? In this bottom, as we've said multiple times and for the last several years, is likely going to be a grind, not like a bottom and then back to peak. So on that note, Dan, let's get into some of the, I kind of hate this term, but some of the loss porn, just to set the stage here. Some examples as to, numbers speaking louder than words here. Okay, so GTA prices down 24% on average from the peak of February 2022. That's an average of like 1.33 million down to just over $1 million. We're over $300,000 wiped out. Condos specifically, no secret or surprise here. Average of $800,000 selling price in 2022, down to $625,000 in today's market. Again, almost $200,000 that are wiped out. And the headline here is that over 36% of Ontario peak buyers, though the 2022 buyers who sold in last year and this year have sold at a loss, and that's from the data from our good friends over at Terranet. That's all within the $500,000 to $1 million price range. So a huge price range, right? I mean, that makes up the bulk of the condo market. Basically, GTA condos are down almost 40%. It's crazy. And this isn't like a little niche of dumb money or whatever. This is a third of the peak cohort of that buying frenzy. They're now selling at a loss, which and likely have been underwater for quite some time, whether, from negative cash flow or mortgage going up or whatever it may be. Selling at a loss was once a very taboo thing. Now I think it's becoming a lot more common.
Yeah. Yeah, I think a lot of people don't want to, they feel like the word literally says loss, right? So they feel like they're losing. And I think, it's really just a cost benefit thing. Like, if you don't know what the word discount rate means, then figure it out. It's basically, what's the opportunity cost of where I could be getting my other or better return on my money. And if I can go look at the S&P 500, and if I had to put my cash just in the S&P 500, and we're real estate guys, so we don't, I don't like that because I'm an idiot and don't put my money in the S&P 500. I put it in random stupid stocks and lose money. That's why I like real estate. But if you were just a sensible, normal investor and you put it in the BMO ETF for the S&P, you could make the 10, 15% on a year-over-year basis. Losing money is not making 10%. I don't maybe it becomes a little bit harder math to substantiate when you think cash on cash, or real estate kind of gets a little bit gray with the leverage or different metrics because there's you add in 25-year hold and capital appreciation and whatever. But if you're losing money, it should be a very clear decision. I can probably get a better return somewhere else. Why are people choosing not to do it? Well, they rationalize, I'm getting my principal paid down or whatever. And there are many reasons why people could do it. Maybe you're so rich or making so much income on an annual basis that you want losses on your books to offset those gains. I don't know, but this is where the individual situation matters. But I would say for the vast majority of people, usually if you're losing money, maybe it's an indication that you're not an excellent real estate investor, and you should think about maybe just dollar cost averaging into something else, or investing in a real estate fund or whatever, or get better at being a real estate investor and sharpen your skills and not end up in that position again. So let's look at a couple of cases here. I know you mentioned that we're like Terranet data, and a lot of the news is coming out of Toronto, obviously. And this isn't, this is happening in other places. Like Montreal seems to be rolling over on the CREA data. Calgary seems to be rolling over on the CREA data. So I would say, what we mentioned this a lot when we talk about Toronto. It's usually the canary in the coal mine. Expect other markets to fall, but you have examples of penthouses going from $125,000 loss, pre-con assignment deals. They bought at $560,000. They were at closing. They had a $40K cash shortfall plus negative cash flow, and they dumped it on an assignment in 2 weeks for $300K under what they paid. Right. So
Wow.
these are the ones where they literally have the deposit. So they've already given a deposit, and they actually have to pay the purchaser to take the unit over. Right. So if I wanted to sell you give you my contract, I would have to give you money, Nick, to take this off of my hands.
I'll take crazy? It.
Yeah.
Yeah, it is.
And then I think there's a lot of people who got trapped in flips as well. Right. Like, I mean, we got stuck in a flip. Obviously we had multiple exits, but we got stuck it was literally just logistics. Like the city demanded a certain type of paperwork that was we were the first deal processed in this fashion.
Literally
and
the
it delayed,
first. So annoying.
And it delayed it by like 3 months, and you kind of missed it. And so that investor ended up doing it as a buy and hold, and it's been fine since then. But I see tons of these deals all the time where they're down to the studs and the person ran out of money, or they just gave up because they were like, well, my exit doesn't even look good anymore. Why do I might as well just stop and just sell it here. Why I keep pumping money in and increasing my exposure to this deal? I'll just dump it now and take the loss. So there's a lot of examples. I think there was a flip where we saw a loss of over like $840,000 in a flip. Yeah. So there's the idea of like actually losing money on a deal, like a resale deal, where it's pretty clear. But then there's also like in the pre-con space, we've seen a lot of people just walking away from commitments that they've made. And the reality is like there's pretty significant court precedent in both Ontario and BC for buyers who choose to not honor the contract and exit the deal, right? So if I said I'm going to buy this condo off of you, Nick, for $500,000, and now on closing it's worth $300,000, and I don't want to buy it anymore, you can go and sell it and then realize the loss. First, you get my deposit, and then you can actually sue me for the difference between whatever is outstanding. So I'm legally obliged to still give you that $500,000 value, even after you've went and realized the difference. And in BC, there was a Supreme Court where a buyer walked from a $1.26 million purchase, and when it resold lower, the court ordered them to pay $360K in damages. Yeah, in many cases, like forfeiting the deposit is obviously on the floor, but I would say that that's not the top end of what you can end up paying if you decide you want to walk away. The builder, in most jurisdictions, if the builder goes and resells the unit for less, they can chase you for the gap. And a lot of pre-con buyers just like didn't think about this. A lot of them weren't even thinking about closing, period, right? They all just thought they were going to YOLO assignment flip TikTok, whatever. And that didn't work. So, I think that's another very important piece of the puzzle. So,
yeah, I agree. And look, we're not going to spend too much more time telling you about how horrible things are and all the hundreds of thousands of dollars that people are losing, because that is not fun to talk about, not fun to hear either, because these are real people and their livelihoods that are, getting in some cases destroyed. And there's no shortage of this kind of stuff online. You want to go look at, people taking big losses, you can find them online. But let's talk about what you should actually do if you are in a position where you are looking down the barrel of selling at a loss. This is a serious consideration for a lot of people right now. So this is the difference between kind of a forced seller or a scared seller. The single most important question you have to ask is, do you have to sell? Right? Is this because of a job loss, a divorce, a renewal or closing coming up that you can't fund or that you are genuinely concerned about, or do you just hate watching the numbers drop and, being that negative cash flow every month, or the CapEx or the OpEx? It could be so many different things, or a combination of those things, right? But if it's forced, you're kind of doing damage control. Now, this is step number one. You skip to step number 3, which is, exhaust all alternatives before you dump it, and we'll get there. But scared but solvent is a bit better, right? Slow things down. Selling this to stop the emotional pain is how people lock in a loss that they don't really, in some cases, have to take just yet, right? You are materializing that loss when you exit.
Yeah, I think after that, you want to start thinking about like the actual bleed rate, not the paper loss. Like everybody focuses on the paper loss, and I think Canadians think about real estate as like a savings vehicle, whether they admit it or not. And so they're comfortable like, oh, I got to put in $1,000 a month, but my tenant's paying, 3,000 and I'm paying, and that, the bank's getting 1,500 or whatever, the bank's getting 2,000 and I'm getting, so my 1,000 is technically going towards the principal or whatever, they rationalize it. And so like the paper loss is it feels like the number that you should be thinking about, but it isn't the number. The number that really drives the decision for most people is how much does this cost me to hold each month and how long can I sustain it? And another factor to add to that is, okay, if I, 2 years ago made the decision that I was going to be cash flow negative and eventually I'm going to run out, or what happens if you're the rosy scenario that you think is going to take place when rents go up and prices go up later or the market's more liquid doesn't happen and prices actually fell over the last 2 years, that paper loss got even bigger. And now,
Dan, are these all the people that were dating the rate and marrying the home?
A lot of divorces in the marry the house people or whatever. Yeah. I mean,
a lot of breakups in the dating the rate, I guess.
Yeah.
Breakup season.
Well, the problem with date the rate is like, you don't, in Canada, you don't really, like, this is very much US phrase. And because you can refi when the rate gets lower. But in Canada, you have to reset at the new rate regardless. So, if interest rates were 2%, you're not dating the rate, or maybe you were dating the rate. And now, after 5 years, the person decided that they were completely different and now they're 5%. Right. And, they're coming home and yelling at you every day. So, and you're stuck, cause you really are married in the mortgage contract. So yeah, I don't know if the marry the house, date the rate thing worked out very well for a lot of people, but how much more are prices going to go down during the period of time that you're white knuckling and absorbing negative cash flow, right? Like 77% of new condo investors are cash flow negative. I think that was a CIBC and Urban Nation report.
Yikes.
And I think they're bleeding on average. What is it? Almost $600 a month. So your math should say negative carry times the months held plus any special assessments if we're talking condos, or maintenance capex that you're gonna have to spend. Renewal risk. Did you stress test it of what happens if you're not renewing at a 2% fixed rate and now at a 5% or 4, whatever we're at right now, 4 point low fours. If there's no line of sight to a break even, which there isn't if you're this far cash flow negative, right? And you're continuing to bleed out. Yeah. If your break even is like 20 years out, then holding is also a loss. Even if you are paying down principal, you add that to your math, that's fine. I'll give you the credit of saying, yeah, somebody, some principal is getting paid down, or I am paying the principal down, which is what you need to admit in a lot of cases when you're the one contributing cash to the deal and it's getting saved in the mortgage for you. There's still a loss associated with that. It's just, you're literally making the decision, do I want to lose money fast or do I want to lose money slow? And it seems like more people are choosing to do the slow one.
Yeah. And I mean, to each their own, right? This is not financial advice. We're just talking here. So let's quickly run through the framework here, Dan. So far, are you a forced seller or a scared seller? What to do in both of those situations? You just went through, don't look at the paper loss as much, run the bleed rate, right? So am I losing money fast or slow? The next step here in the framework of should you actually sell the loss is, have you exhausted all the alternatives before you dump it, right? Obviously, if this is such a difficult decision for so many people, they're really thinking about it, right? And some people might not know what alternatives or options they have, right? So, and again, not advice here. These are just things that you can do. Every situation is different. So you can look at maybe refinancing or extending your amortization. Again, I wouldn't really, I'd be very careful with both of those. You can try to rent whatever you are considering selling and carry it. So we've seen this a lot, Dan, where people, try to list. They can't get the price, whatever it may be. So they go and try to at least minimize the damage by bringing in some money a month. The thing is, the rental market isn't so hot right now either, so that can be difficult, especially depending on what kind of product.
I think on that there's a bit of a version as well where you increase your exposure, right? You add a basement apartment or a garden suite or something, and now all of a sudden it does get to cash flow positive, and you've added some value to the property that might push you on side. Like that was something we were advising a lot, and it seems to be going well. I mean, if you own a detached in Ontario or many of the places across Canada that have been upzoned, you can add more units. that has been saving a lot of people. The problem that I think a lot of people who are in bad positions, they don't have the money to do that.
Yeah, that costs money, right? And if you're this concerned about money, do I invest more into this thing that is causing me emotional distress and financial distress, or do I just again walk away? And there's you can go the assignment route if you want to, if you need to. But that whole market is kind of dried up and is kind of sketchy. You can negotiate with the builder in certain cases if you bought something and you haven't moved in yet. Some builders are cutting deals or adding incentives. Man, I'm even seeing landlords adding a ton of incentives. Move into this brand new building, months of rent free.
Yeah.
Utilities paid, whatever it may be. So I mean, look, there's a lot of ways to do this. There's a lot of options to explore. Selling at a loss should not be the first thing. It's not the first rung on the ladder. It should be the last, especially if it's something that you're struggling with.
Yeah. Yeah. We were seeing tons of builders like, we went through the path earlier. So like you fail to close and then the builder sues you for the difference. They don't necessarily want to do that. It costs them money. So they're going to have to, yeah, sure, they can bill you for the legals or whatever, but okay, well, they'll maybe vet the borrower and be like, yeah, this guy's just going to go bankrupt, or I'm trying to take blood from a stone. So they'll say, hey, well, we'll give you, I've heard of as much as like 300K reductions in price if they close. So
Crazy.
yeah. The other piece is like, don't ignore the tax angle. Yeah. I've seen like a lot of my investor clients right now, like I'm talking huge funds that, they make lots of money, right? And they're buying properties at 2 caps that are cash flow negative. Well, why? Because they're buying them for the next cycle. They're buying something that's a future development site, and they're saying, okay, well, we have too much income and we're paying too much tax, so we can afford to have a cash flow negative site and take a loss on our portfolio because we need to offset some stuff. So that's on the cash flow side, but on an investment property, you can also have a capital loss. And then I think it can be carried like back 3 years or forward indefinitely against capital gains. So the real loss is smaller than the sticker if you have gains elsewhere in the portfolio, or that you would individually claim. Your primary residence, obviously a completely different story. It's kind of I've learned this the hard way with my TFSA. You don't pay capital gains on the upside, but you don't pay capital loss on the downside, or you can't claim a capital loss on the downside. So your principal residence, because it's not, you can't claim, or you don't pay capital gains if you win on it, you also can't deduct a loss on it. And again, none of this stuff is tax advice. Literally reading this stuff from the CRA website for the purposes of research, and we're just sharing information with you. If talk to your accountant. And my advice for you would be never go and make a tax advice or tax decision based on anything you hear on a podcast or YouTube or whatever. There's a reason that accountants exist. This is among them, to talk to them about things like this.
100%. We have accountants, Dan, both together and separately, right? So go talk to your accountant. Okay, so yeah, you're right. Don't ignore the tax angle. This is a huge implication for a lot of people, depending on what asset you're holding and what your situation is. And okay, let's kind of round this off, the framework here with the final step. The final thing to consider is the buy and hold counter argument, right? This is always the counter argument we hear from people. The whole team never sell, blah blah blah, right? Let's look at the historical case. Back in 1989, great year if I do say so myself. The peak fell 21% over 4 years, slid to almost 30% by 1995, and didn't recover in real terms, adjusted for inflation and everything, until 2011. Okay, but those that could hold throughout that very long period, of course, they came out way ahead. The catch is the buy and hold only wins if you can actually afford it. If this thing is slowly killing you throughout that decade or more long process of, peak to trough to peak again, that's not the strategy for you. It's a strategy for staying power, not a coping mechanism for people who are either treading water or currently underwater. So the takeaway for me here, Dan, is selling at a loss isn't a failure. Okay, staying in a position you can't afford is a failure. If you bleed, if the bleed is sustainable and your horizon is long, then hold it. Okay, if not, then take the loss, protect your credit, your sleep, and you can live to invest another day. You know, sometimes the best deal is not doing it. Sometimes the hardest decision is the right one. The worst outcome is the person who white knuckles through this thing like it's, you know, Bitcoin and gets forced out at the bottom anyways, destroys their finances and likely affects their personal lives as well.
Yeah, there's a couple things I'll add to that, and then I'll let you get into sort of like advice that, again, not financial advice, but advice that we hear
Just
that
advice from your
yeah, well,
buddies.
key
Yeah.
points that that typically like that you would wrap around these kinds of discussions. But the hold period is an important part. Like when you mentioned the 1990s, it's like, okay, sure, people were eventually made whole or they ended up doing better. Well, they obviously didn't do better than somebody who bought at the bottom. You know, if you bought in 89 and you had to ride through all of that, but okay, in order to be made whole, I had to wait 20 years, 22 years inflation adjusted for the price to get back, plus, you know, all the negative cash flow that I absorbed. Again, if like most people who are getting into real estate investing, they are thinking in like 10-year increments. They should be thinking in 25-year increments. That's something you really need to evaluate is like, do I really want to own this thing as long as it's going to take for this investment to break even? Or does it actually make more sense for me to rotate into something that makes a little bit more, you know, that fits my portfolio better? And the other piece that I'll add that I think, you know, is a good sniff test for people to see whether or not, like, because there's another risk that you don't even know that you're going to end up bleeding out like completely, right? Eventually you lose enough blood that you die and you wish that you actually just sold and, you know, took the harder thing, maybe cut a finger off or whatever in the process. Trying to, I'm not really milking that analogy, but
I was gonna say, yeah, this is getting like Saw level.
going full Dexter here. But the
Yeah.
Bank of Canada, we did, I think, a bit of a thing on this on the show about the Consumer's Path to Mortgage Delinquency report. I don't remember. You remember that?
Yeah, we covered that
Yeah.
report. Yeah.
So
Yeah.
that report describes the process, and like one thing that I think is worth you paying attention to is, are you starting to like, do you find yourself starting to maybe pay out of pocket for other things that, you know, aren't just the difference in the mortgage product, but maybe your own personal finances? Oh, now I'm starting to add stuff to credit cards, or, you know, if that's you dealing with inflation or dealing with a bad portfolio and you're not really even realizing it. Oh, my credit card, I've never carried a credit card balance before, but now all of a sudden I have $5 or $6 or $10,000 credit card balance. That's you dealing with a negative financial situation using debt, and more expensive debt than you have on those other properties, by the way.
Yeah. I mean, you're 19%
Yeah.
in a lot of cases.
Yeah, or like 22, right? So
Yeah.
you know, the Bank of Canada observes it in their report where it shows people slowly piling on stuff, and then their credit gets damaged, so they don't have an exit. They can't refi to pull, you know, a HELOC out to square up and, you know, drop that interest rate from 22 to 5% and consolidate the debt or whatever, because their credit's damaged from using it. If you notice that you're kind of going down that path, accompanied by negative cash flow, et cetera, be conscious of it, because that's really where you know, I think a lot of people, like, nobody uses a credit card and it's like, yeah, I'm just going to hold this balance forever, right? They're like, yeah, I'm going to pay, well, hopefully not, but they're like, I'm going to pay this off. I plan on paying this off within, you know, whatever, a couple months or a year. You have to be realistic with yourself about the outcome. You know, you can't just be like, oh, this is going to blow over. It hasn't blown over in the last 2 years. You know, imagining that it'll blow over in the next 2 years, you know, seems like a bit of a fool's errand. So that would be my advice to people, is like, be super realistic and pay really self-aware about the way that you're using your money to deal with financial problems in your portfolio or your personal life. Because you know, there is clear data that this stuff compounds and gets ugly pretty quickly.
Yeah, no, well said, man. Okay, so you know, you finished that piece off there with a little advice. Let's keep going down that train. I think that we can offer some good advice for people that are in this situation, right? I mean, my first thing would be, don't make a 10-year decision on a 10-day emotion. Now, obviously, I'm being hyperbolic here. You know, a 10-day emotion, you might have been in, this might be stressful for months, but it's always more difficult to think, what is my future self going to thank me or scold me for, right? So the market doesn't care what you paid. Your break-even price is essentially irrelevant to everyone other than you. So stop anchoring to that number. Never sell to point of maximum pain unless you are forced, right? You want to try to be in the driver's seat of this storm, right? The only thing worse than driving through a storm is driving through a storm with no one at the wheel. That's how a paper loss becomes a permanent one. So really know your numbers, stress test all your stuff. And then really try to, this is where the difference between, again, like we talk a lot about commercial real estate, Dan, we talk a lot about residential real estate. This is the main difference between commercial and residential is emotion for a lot of people. So you want to remove the emotion from it, separate the anxiety from the asset, okay? Like, yes, the panic and the anxiety and the stuff is real, but applying that to decision making when it comes to something like this is only going to hurt you more in the
And
long
not even
run.
just the asset, but like separate ego from it. Like nobody's gonna like people aren't gonna. I mean,
Yeah.
maybe there are some
Yeah.
like people who will shame you on Twitter, like and post your listing if you took a huge loss. But like, I mean, does anybody really care about those people? Like, like I think they have
Exactly.
better, or I think they have bigger problems to worry about if they're celebrating people's financial distress than you do as the person who's experiencing it. So, like pull ego out and don't be afraid if it's the right decision. Actually take pride in, hey, I had the guts to push through and make a very hard decision because it was the right thing to do. And I'm that shows wisdom and strength, I think, more than anything.
Agreed.
The like liquidity is a thing that really comes to mind to me. Obviously, like cash is so essential in downturns. Obviously, it'd be perfect if you had a bunch of dry powder sitting around and you could do deals and buy all these discounted properties that we're seeing right now. But keep a reserve. Obviously, like if you're like scraping together cash like month to month to make this work, like you're already in trouble, and that you should really be thinking about selling as a path. 6 to 12 months of negative carry plus possible capex, or if we're talking condos, like special assessments or increases in fees or whatever, stuff breaks. Like that's just part of the asset class.
Yeah.
If you
Dishwashers aren't cheap, man.
right.
Like stuff always happens,
And
right?
again,
Yeah.
like it's very easy to think, oh, I can afford this, but then the furnace breaks and you toss it on a credit card and you end up on that Bank of Canada report that I just mentioned. So you have to be aware, pay a lot of attention to this stuff. Call your lender before you miss a payment, not after. Well, they'll call you after, so don't worry about that. But call them before, right? Like there are options. So like try and work with your lender. They do want to work with you. They don't want to unless you're like on an individual private that was like a YOLO deal and you're loan to own. Yeah, okay, maybe you're in trouble there, but in most cases, lenders want to work with borrowers. And another important piece to note is like mortgages in Canada are largely full recourse. So walking away doesn't wipe away the debt. Like if you have a court judgment that the lender,
This
it's
is
not America.
this is where
Yeah.
I'm literally going to physically run away from my
Yeah.
problems. Like you cannot do that
Yeah.
here.
Yeah. And so it's not like, the US where you can strategically default on properties and go bankrupt and whatever, move on with your life. You're going to have judgments that are going to be very much that like they will follow you around. They'll get their money. They'll garnish your wages. It's like same as the landlord and tenant board now, same as the builders who are going to sue you if they have to realize damages. Like so just because you haven't, or you realize the loss, or you didn't do it on the market where you felt, where you had to actually like write a check, somebody's going to make you write the check eventually.
People will come for their money. I mean, and speaking of money, I think that's another really important piece here. Like, don't try to average down by the dip, dollar cost average it into something that you can't afford with money that you can't afford to lose, right? Buying the dip, that old, saying only works if you can survive being wrong about where the bottom is. And guess what? No one knows where the bottom is. Nobody rings a bell at the bottom. It's not announced. We've been calling it for years on this podcast. I think we've been kind of right, but we don't have a bell, Dan. We don't have a date saying this is it. It'll be like this for the foreseeable future, and then it will start to go back up. Trying to nail the exact turn is how so many people either miss it completely or they're the first ones to catch that falling knife, which is the last thing you want to do. And I think you're right. Again, keeping that dry powder, which essentially just means having a cash reserve of something, just even a couple months. I mean, obviously the 6 to 12 months is ideal, but even just desperate times, like get 3 months of backfill for all this stuff that can go wrong. Those are the attitudes and the practices of homeowners, investors that are going to make it through these times and likely win in the next cycle, whenever that may be, when a lot of other people have been forced to sell in the meantime.
Yeah, I think that to combine those two factors, like, okay, the bottom is like, well, let's say we're obviously closer to the bottom today than if you're in a negative negative equity situation than we were a couple of years ago when you bought the property. So forget the purchase price. Would you buy this unit today at today's price and today's carrying costs, today's interest rate, today's rents, today's path that the prices are on? And like if not, then that's probably real information on whether to hold. Like, this is like people who,
Yeah.
it's like when you're in stocks and it's like, oh, I paid the, $100 for the stock and now it's down. I'm down 50%, but I'm not going to sell it. Like, why would you not? So you're choosing to rebuy it basically at $50, right? Well, why don't you buy more then? You need to think about real estate the same way. Because and okay, yeah, if I like the asset and I don't, and I believe in it, well, I could increase my exposure and add a basement apartment or a garden suite or whatever. The other thing is like fundamentals, obviously, underwrite on those things, not hope of appreciation, because that piece is obvious. Hopefully you've learned over the last couple of years that that thesis is very volatile and can create a lot of pain. So you should have been underwriting on fundamentals before, but if you weren't, then now is the time. Well, yesterday and the day before that and whatever. But if it works stress tested on a new renewal rate, or breaks even. I mean, a lot of people are now going to be resetting at lower rates and actually seeing improvements. I know my portfolio is going to start rolling over into much better rates, and like I'm going to go from not a bad margin, but to a much better margin. But if it bleeds indefinitely with no path to a break even, that is not an investment, right? It's really just some sunk cost that you're white knuckling through, and it's probably not going to end well for you.
Yeah, totally. And I mean, this is where that kind of like sunk cost fallacy comes into play, right? Which, for those that aren't familiar, is basically like a cognitive bias where you keep on doing something, you keep on doing that thing because you've already spent time or money or effort. You do this when you should be stopping. That's the logical and better thing to do. It's a logical choice, but you just have this feeling of, I need to keep doing it because of what I've done so far. But you got to get rid of that, because money already lost is gone, and in a lot of cases that should not be driving your next move, especially if you can't afford it. Every investor who lasts in any market, stocks, bonds, crypto, real estate, whatever, private equity, whatever you're investing in, you have taken a loss. Okay, and if you haven't, congratulations, you haven't been investing long enough. Okay. Treat it as tuition. Treat it as like pay to play, not as an identity as, well, I'm a loser, I'm a bad investor. It doesn't make you a bad investor. Making decisions based off of ego and ignorance do, right? So real estate is a game of decades. It's a game of years and years and years, not, the quick turnaround. One bad event, or even two bad events, even three bad events, rarely ends you. And, that should not be what kills you in your investing career. Over leverage is what usually does it. So, use that as a harsh lesson as to maybe 95 to 5% on an MLI Select loan isn't the best idea for me. Maybe levering up and pulling as much money out and trying to grow as fast as possible isn't the best option for me. Usually is not, I should say.
Yeah. Yeah, and if you feel like you need like to analyze these numbers a bit more thoroughly with your personal situation, like call myself, call Nick. We'll gladly talk through these situations with you, no matter where in Canada you live. We have a calculator on the realist.ca website where you can analyze this stuff. Make sure you go check that out. I don't know if this event's coming out before multiplex, or this episode's coming out before multiplex, Nick. But the other thing I would say is hope to see you at our multiplex event, either in Toronto or Montreal, because they're both. But Toronto, September 15th. It's gonna be huge. I think we've already sold a ton of the tickets. We got sponsors.
Yeah, well over 100 tickets sold. We got people reaching out for sponsors every day. It's awesome, man. The buzzer on this is cool.
Yeah, it's gonna be a good one. So we'll hope to see you there. And thanks a lot for taking time to listen, and we'll see you again in a couple of days.